Hello, this is David Oppedahl from the Federal Reserve Bank of Chicago, and I'm looking forward to sharing with you some information on the economic outlook for the food service industry. And we have a few interesting things to learn in terms of the Federal Reserve as well. So let's get started. The views expressed in this presentation are my own and do not necessarily reflect those of the Federal Reserve Bank of Chicago or the Federal Reserve System. And here you can see the system, and the Board of Governors in Washington, D.C. oversees the 12 regional districts, including Chicago, which is District 7, and the 5 states around us, including Illinois, Indiana, Michigan, Wisconsin, and Iowa is the only state we have the entirety of in our district. So a lot of agricultural production, a lot of food service jobs in this region. So it's a key area for our regional economy as well as the national economy. And I just wanted to start off a little bit of setting up where we are today by looking back a year ago. And we started off in last March with the increase in COVID cases that we thought was pretty dramatic. And at the time, it was very challenging for the US economy as we saw a deep downturn as the economy needed to slow down and in most cases even stop in order to allow us to fight the COVID pandemic. And eventually we saw a second and third wave of the cases, as you can see in this chart, that reached a very high level over January of this year. And then finally, thankfully, we've seen that come down pretty dramatically in February and March. And now into April, there's been kind of a leveling off as we have at this level that's still too high, but at the same time is something more manageable. And as we go ahead, it looks like vaccinations are going to be able to ramp up dramatically and help to get the population so that the COVID cases will stay low. And so that's where we're at in terms of the pandemic, and it has affected the economy in many ways and in many sectors. One of them in particular is the food service sector. And so we'll talk about that a little more. But first, I'd like to kind of set the stage by thinking about the National Activity Index that the Chicago Fed puts out, which is similar to taking your pulse. So this is kind of the pulse of the economy. Anything above 0 indicates above trend growth. Anything below 0 indicates below trend growth. And here you can see from this 3-month average of the index, which covers around 100 different data sources within the economy. So covers a lot of the economy and gives us kind of a summary statistic in one measure. So in the current downturn, we saw deep drops that were much larger than even the Great Recession of 2008 and 9. And then we saw a very rapid recovery in terms of growth already occurring last summer and moving up at a very high level as reopenings occurred during that time. And then since that period, it's kind of tapered off and only had about trend growth, which is around 2% for the US economy in the gross domestic product. So, kind of weaker growth by the end of the year in 2020, but hopefully this first quarter of 2021 came out of the gates a little stronger than that. There does seem to be evidence of that, even though there were some challenges in the first quarter of 2021. Still, it's such a traumatic time for the US economy with lots of jobs lost during this period. And then the recovery has been relatively less strong than we would have liked, although maybe has been a little faster than some had anticipated. And here's one example of how deep the challenges we're facing have been. If you look here at the percent change in the number of small business establishments that are open, in particular the hospitality and the leisure and food service sectors. In the bottom line, the drops were about half, and we're still, down at that same kind of level, about, a cut in half of the number of uh, establishments, because it's been a continuing and a long-term phenomenon over the last year, and it challenges these companies to stay open, even though you can see there have been a number of programs that have been instituted, from the PPP loans and their forgiveness, through all the different kinds of stimulus efforts that were put through by the federal government and local and state governments as well. So it's still a challenging period. Lots of small businesses have closed, and then along with that, lots of jobs were lost. And looking at specifically the food economy, the disruptions have been quite severe, with food distribution networks having to deal with many logistical challenges, and the loss of demand for food services, including schools. These were issues that led to the problems in getting the food products to the right people at the right places. And it was especially severe for the dairy sector. So milk got dumped because you couldn't get it into the right kind of containers after the food services didn't need it, and there wasn't a place for it to go, and it's a perishable product. The grocery shelves were emptying out, but the milk could not fill it fast enough. And so it was a very big challenge for the food production sectors. They were hurt by COVID cases as well, when you had meat packing plants that were shut down. And this all led to a jump in food eaten at home, as well as an increase in food prices. The switch in consumer behavior was pretty dramatic. As the cases of COVID were spiking, people followed the guidance, and they needed to eat at home. And then food takeout and delivery began to really pick up, but at the same time, that wasn't necessarily the same food service establishments that had lost their customers, and so many restaurants had to close. And it was a period where the unemployment rate in food services was up about 30% from February and April last year. And then the food processing sector unemployment rose about 4.4%. And on the other hand, food production itself, unemployment dropped 1.4 percentage points. So it was definitely a pandemic recession that led to various outcomes. And if you looked at delivery services, those had a big increase in their employment as well. So that was the initial stage that was very challenging. The additional stages from May to August, we had continued declines in, the ability of people to get out in some cases. But then other parts of the economy were opening up. And so there was kind of a dual effect. And as the rest of the economy started to open up more, unemployment in food services dropped 13.5 percentage points, food processing minus 4.4 percentage points, and then food production also had unemployment dropping. So employment came back, but at the same time, it was not always the same people in those jobs, and there was a lot of disruption in many of these businesses, which tend to be small. And then after the 50% increase in groceries and spending on the various kinds of food services that people could get at home, those are transitions that are going to continue. And when you think about the consumer over the next period of time, they're having to adjust their expectations and their behaviors, because they've gone through this period where they couldn't go out and eat at restaurants, and they maybe, as the slide on the right side shows, got interested in cooking at home. So cookbooks were a hot item in 2020, and the pandemic kitchen led to things like baking and runs on flour. And at the same time that was happening, you had a lot of snacking going on, and companies like ConAgra, as the headline shows, bet on new consumer behaviors that might outlast the pandemic. watching a movie at home instead of in the theater, and making your own popcorn is something that may be with us for a while as people adjusted and upgraded their home theater systems. So a lot of changes that have happened over the last year have led to some permanent and maybe some temporary changes over time, but online shopping is likely here to stay. I think local food has seen a boost that's probably going to continue. And then, of course, food safety is something that everyone has on their minds. So as all this was happening in the US economy, the Federal Reserve System had to take action because of our dual mandate that we want to both support full employment and moderate price increases. We had to act quickly given the drops in employment and the major problems that the economy was experiencing as it entered a recession a year ago. And this chart shows how the Fed funds rate target, the primary tool in most periods for the US economy, has had to decline pretty dramatically again, and it's been close to zero all this last year, which is similar to what happened in the last recession. But there we started at a higher level in terms of the interest rates coming into the recession, and then they had to stay low for a longer period of time than we would have expected normally, as they were bounded by zero, and as interest rates dropped, additional stimulus was needed for the monetary supply. And so that led to what many have seen as quantitative easing, or asset purchases by the Fed. And you can see that back in the 2008-2009 timeframe, we had some big increases in our balance sheet for special programs during the financial crisis at that time. But then over the next few years, there were additional increases in our balance sheet. Eventually, it got over $4 trillion in 2015 as the recovery was slower than anticipated. And so there was stimulus that continued through that period. But then now in this current period, we've seen the balance sheet of the Federal Reserve System increase even more dramatically. It was increased very quickly in the early parts of the pandemic, and it ended up over $7 trillion and rising towards $8 trillion here. So you can see that it's been a very challenging experience for not only the US economy, but then the stimulus side, that, in terms of monetary stimulus here, it's helped to keep from having any major financial meltdown this time. So quite a different recession than the Great Recession, where there was, the problems with the housing sector leading into that recession. And right now, the housing sector is one of the hot parts of this economy. So that's something different as well. And just in terms of some financial aspects of this period, you can see that we did have a flight to quality in terms of a spread between corporate high yield securities and corporate AAA, more safe securities. And that spiked at the start of the pandemic, but came down fairly rapidly, and now is actually under the level it was prior to the pandemic. So there seems to be some moderation in terms of people's worries about the financial side of the pandemic recession. And right now that's reassuring. At the other side of the finance, we can think about record stock prices and how they've risen up out of the ashes pretty quickly. They had dropped quite dramatically along with the economy last spring, and now they've risen well above their previous peaks. Here you can see they're adjusted for inflation. So very interesting to see how the financial side has not been as dramatically affected as the real side of the economy. And here also the housing market is starting to heat up again. Last spring also took a downturn, but it recovered fairly quickly, and now things like homes are in high demand. You have a lot of people that wanted to move out of cities into the suburban areas or rural areas, and so there is demand in much of the country for new homes. And so the home builders have responded and picked up their housing starts again, and things like lumber are, seeing high increases in costs. So it's been a challenging time for housing starts. Even when you have such a big spurt in growth, it can lead to its own challenges, and one of those is the labor side, that there's just not enough workers to help build all the homes that people would like to buy. And in real estate, there's just not enough inventory available for home buyers to look at. And if you're going to make an offer, you better do it fast, because in certain markets, in certain locations in particular, there's multiple people looking to buy those homes and are bidding up the prices in many cases. So it's on the right side, you can see that the home mortgage rates are very low right now, not quite as low as they were during some times in the last year, but still at levels that are making it more affordable for people to buy their homes. And at the same time, the bidding wars are kind of working against that. So it'll be interesting to see how things shake out with these hot kinds of housing markets. And over time, hopefully there'll be enough building. You can see on the left that we're only up to kind of the levels that were more normal prior to the big housing boom we had, and then we had the bust that took us well below the levels that we would normally have had coming out of a recession. So here we are in a hot market with pretty big increases in home prices. Another area that's been pretty strong has been the manufacturing sector, and this is reflected in the purchasing managers composite index for both the nation and for Chicago. Anything above 50 indicates expansion in the manufacturing sector, and right now we're at some of the higher levels that we've seen, including, I think, a record for the nation. So it's a challenge for them in terms of having so much business return that it's, we're seeing logistical challenges, we're seeing problems with having the kinds of materials you need. Raw material prices are up, and there's some shortages of things like steel. And so it's a big increase in industrial output. Here you can see that there was a bit of a downturn in February because of the weather issues around the country, especially down in the south. And so energy production was cut back. And so there was a dip, but at the same time, we're getting close to the pre-pandemic levels for manufacturing output, and there should be a bounce back from that we'll see when the numbers come out for March. So it's a pretty important sector for stimulating the economy. So it's great to see the manufacturing sector moving forward. One of the key parts of the manufacturing sector for our district in particular is the light vehicle production. And here you can see that total light vehicle units were rising up towards the levels that we're seeing prior to the pandemic, but not quite there yet for total light vehicles or for passenger cars, where the trend is against them. But for light trucks, we're pretty much up to that level, and still there aren't enough available for certain models in particular. So the manufacturers of light trucks are facing tight inventories that they, and we're seeing microchips in particular be something that, are just in tight supply, and then they can't produce the vehicles as quickly as they would like because of not having enough of them. So the auto sector's on its way towards, healthy numbers for this year, but constrained a little bit because of those logistical issues. And that's something that hopefully will be ironed out towards the summer and towards the fall. And when you think about employment, that's a key indicator for the US economy. And here you can see how employment dropped so dramatically from a year ago in the United States. and for the Midwest, and it just was down over 15% at one point, but then it came back to be about 5% down for the year. Um, so, still a very significant decrease, which, that's about as far down as employment drop was in the Great Recession last time, and that's about where we were by the end of the year. So still a long ways to go on the employment side of the recovery. It's a challenging time that we've seen, a lot of issues with various groups in the economy, and some, such as those that work in the food service sector, have seen greater unemployment and job losses than other parts. So here you can see the overall unemployment rate has been coming down now to 6% for the United States in March. At the same time, the Midwest has recovered a little bit more quick than that, but way down from the peak, and then much lower than we were at the same period of the Great Recession and recovery there. So that's kind of how you would expect it to be in this type of an economy, where you had such a deep drop from a reason other than an economic one. As we started to reopen the economy last year, a lot of people came back to work quickly, and programs such as the PPP and others helped many companies to maintain their job levels higher than they otherwise would have been. So one of the things that's happened more recently now is that the unemployment insurance claims have actually fallen below the previous record that we had seen, almost 700,000. And so we had one week below that after having 52 weeks above it. So a full year of, of the unemployment insurance claims being higher than they ever had been before. And as you can see from this chart, the average in 2019 was only a little over 200,000. So a big increase in terms of the claims, and of course, those have been continued longer maybe than they otherwise would have, in terms of the government support through some of the stimulus packages that have provided additional weeks of benefits. So it's a period that we've seen some improvement now. We're down from those very high levels of a year ago, but still long ways to go before we get close to the levels that are more normal, especially those of 2019. And another aspect of employment that is still challenged is the full-time employment versus part-time. Here you can see the red line indicates full-time employment is still well down from where it had been, about 125 million jobs, whereas it was getting close to 135 million jobs before the recession. And overall, some of the more recent recovery has been part-time jobs. So we'd hope that those jobs would be switching toward full-time jobs, and people would be able to find additional full-time work in the near future, even though some of the recovery has focused on the part-time jobs that are more available now, and hopefully that will be switching soon, as there's a challenging time for many of those workers still, and for those that just kind of dropped out of the workforce because of the health issues and their concerns over whether they would be safe when they were at work. So there should be able to be some additional workforce entering now that vaccinations are becoming more commonplace and available. One of the parts of the labor market that's been doing well is manufacturing, and that's something that is leading to higher wages for workers. Here you can see that real average hourly earnings had been moving up around 2% over the last year now. So relatively strong increases in income for workers, as they're needing, as companies need to hire additional workers and they can't find them, they're raising wages, and then that's helping to move up wages for others that are already in the job. So it's been a period where we've started to see some of that pressure for wages, and that could possibly move into broader parts of the economy, although we haven't seen that yet. When you look at prices side of things, the other part of our dual mandate that you can see here that oil prices have dropped sharply in the early parts of the recession, but then they've returned more recently as we've started to see people driving again after they had to stay at home. And so the oil usage is up, but then there was also a constraint on the supply side that a lot of production slowed, and so now some of that's coming back as well. So that should help to keep oil prices from rising as dramatically as they did in the earlier recession in 2008 and 9, but then we didn't get stuck down at lower levels as long either. So there's a lot of volatility in energy prices, and they're rising again now. When you think about other increases in prices, food prices have risen over where they were a year ago, about 4% during parts of the recession, a little under that now, as you can see here. So a lot of volatility there as well when you see some of the earlier periods, ups and downs for food prices, moving around the core price level, which takes out food and energy, and everything else in the economy is included in the core. This is the consumer price index, so it's one measure that accounts for lots of different activity in a basket of consumer purchases. And right now, we haven't seen a big increase in the overall level of the inflation pressures. Core is still well below 2% and hasn't been rising yet. So that's something that is at the back of the minds of the Federal Reserve, that we do anticipate some increase in prices now, and that's something that would be appropriate under these kinds of economic conditions to see, to help kind of balance out the lower prices we've seen before. One other key component of the U.S. economy is the exports and imports through international markets. There's been a little boost this year because of the drop in the past year over after an increase at the very beginning of the pandemic in the value of the dollar. It's been down now quite a bit from the spike that was seen, and it's supportive of additional exports of agricultural products and many other products. Here you can see that exports and imports were both down last year, and so the international trade was hurt, and now it continues to be challenged by many factors, including logistics issues and unloading and uploading new ships, and then they get one stuck in the Suez Canal, and that makes it even harder for some of the transportation sector. So it's a challenging time, but hopefully there will be a pickup in both imports and exports that will help boost trade in the U.S. economy. And then when you think about agriculture and its role in international trade, it's one of the areas that actually has a trade surplus for the United States, and so exports have been outrunning imports for a long time, and that's been very helpful, although they narrowed in the last few years. But then now the anticipation from the USDA forecast is that there'll be increase and widen a little bit this year, as we have started to see a big comeback in the purchases of agricultural products by China. So that dropped off in the last 5 years, but then has bounced back the last couple of years as we had agreements for some of the trade products there, and the Chinese just needed to feed their own people, and so there were some issues with their hog production and other ability to be able to buy enough products and internally produce them. So they've had to turn to trade, and so that's been very helpful for our agricultural trade balance, and anticipate that that would be continuing to help boost our Midwestern producers. And in fact, we do see this in terms of farmland values. This is just one indicator of the health of agriculture, and here you can see that in the previous 6 years there had been lagging farmland values, and then finally in 2020 they bounced up around 6% from a year ago, so fairly strong recovery after a long period of down time for the farm incomes and than just needing to recover from some of the rapid increases that had occurred prior to that. So a challenging time for agriculture a year ago turned out to end up in a fairly good year with higher prices for corn and soybeans and many other products, although some like the dairy sector saw a lot more volatility than others. And yet, the government supported in many ways as well, and that helped to boost farmland values in addition. So where do we see the economy going? The Federal Open Market Committee, each member puts out a forecast 4 times a year, and the most recent one from March shows that, and I guess the way to think about this is the red bar indicates kind of the center of that forecast where the majority of the participants viewed things going. And for this year, 2021, you can see that the view on inflation is that it'll be up over 2%, up around 2.5%, which would actually fall into the new kind of monetary thinking that we want to try to average around 2%. We've been below that for several years, and now it would be appropriate to have inflation run a little faster than our target of 2%, and then that would help to keep the economy steady and stable and to promote economic growth in the long run. Now, the anticipation is that inflation will be falling the next couple of years, or not falling, but lower towards that 2% target then in 2022 and 2023. At the same time that inflation would be up, the gross domestic product is going to be up a lot this year. So that's the anticipation that there would be a boost to economic activity in the recovery, up towards 6% or so, and that would really engender some of the higher increase in prices that we are thinking will occur. And so it's an important period that we would hopefully have already seen in the first quarter when the numbers come out later this month, that there was this kind of movement up in the economic growth after the worst of the pandemic is behind us. And in the next couple of years then have economic growth be moving down towards the long-term trend, which is about 2%. So still above trend growth for the next couple of years after this big jump this year as the recovery really kicks into gear. And then on unemployment, we had the big increase in 2020, ended up over 6% for the year. And then now this year should be down closer to 4% and a little under that for the next couple of years as moving towards that longer term rate of around 4% for unemployment. So it's still a challenging period. Lots of, recovery and healing needs to happen for the economy, just like it does for individuals. One of the things that is helping with that is the Fed funds rate target should remain low for the next few years. Here you can see the dot plot where each individual member of the Federal Open Market Committee has a dot representing their views on interest rates, and all of them see interest rates staying low this year. And then next year and the year after, just a handful show an increase. And so it's still going to be a while before interest rates get up to that longer run trend of about 2.5%. So relatively low short-term interest rates. Of course, long-term interest rates have been moving up some this year. And so that's, leading to a little bit of a spread there, but still not, moving up that rapidly. In summary, then, it looks like the U.S. economy is going to expand at a pace above trend for the next few years after the big drop-off last year, and employment is going to continue rising with the hope that unemployment will get, the rates there will get down below the levels of 4%, and it'll help to heal, the broad job market, and as well as some of those pockets where there were higher rates of unemployment even than what we saw overall. And housing and manufacturing are some of the sectors that are doing quite well, and they're anticipated to continue growing. Agriculture had a strong 2020 in the end. It wasn't anticipated that it was going to be such a good year, when we started a year ago. But now that we've seen the government support continuing, that's something that'll help a little bit in the current year, but it won't be as big of support as it was last year. So some challenges could come up. Some of the sectors of the food and economy are still being challenged as they have to deal with how to reopen and whether some businesses are going to be able to reopen after having been closed for a long time. And of course, nice weather now is helping around Chicago to get people out, and we can eat outside more easily again. So the winter's over, and hopefully for the economy as well as for personal lives, we'll start to move back towards something a little more normal after such a long year of having to deal with what's been coming through the pandemic and all the associated ways in which we try to keep people from getting sick. And so hopefully this coming year we'll see a revival in the food sector in particular, and that's something that I think it's poised to happen, but it's just going to take time, and there will be new trends, there will be changes in behavior of consumers that have to be accounted for. But I think overall that it's a period that might be healthy in the sense that people are coming back and eating in new ways, and they've been exposed to some additional techniques in cooking, and so there's a lot of activity and a lot of interest in food, and that's a positive for the sector.